Nothing very much to show for, at least at the start, at an index level. Stocks, of course, I'm sure will be a different kind of a reaction. Individual names would be popping up and selling off as well. The Nifty heat map should come into view, and they'll give you a first sense of what the overall picture is looking like, because the index is flat. So more down than up, 30 down, maybe 32, 33 down, and about 15, 18 stocks which are higher at this point in time. 10 points down on the Nifty. Surabhi.
All right, let's break it down and get into stocks then. Very, very flat on the Nifty, at least as of now. So let's see where the red is coming up from. Shriram Finance, Tech Mahindra, IndusInd Bank, SBI Life, Infosys, Wipro. So the early trends are telling us that financials and tech not looking too hot this morning. HCL Tech is down about 0.5%. Infosys dropping almost 1%. Let's see what TCS is doing ahead of numbers which come out tomorrow. TCS is absolutely flat for the time being. BEL, Bharti Airtel, HDFC Bank is quite weak, about 0.5% lower. So financials and tech, not that great. Let's see the other side. Dr. Reddy's is reacting well to the fact that they're selling off one of those units in the US, I think, which is not of much use to them. 3% up now on that stock. ONGC is continuing its solid form from yesterday. Remember the CLSA note, which is very, very optimistic on ONGC. Another 2% on that stock this morning. And the positive brokerage commentary that we've seen on Reliance, that's rubbing off well on this one. RIL is up 1% as well. L&T is having a decent morning. Eicher Motors seeing some buying as well. Actually, M&M also on the upside. Autos largely are okay. M&M, Maruti, Hero, Eicher. Some green on autos, green on ONGC and Reliance. That pretty much sums up the picture. Actually, ITC and Lever as well. Some of these FMCG heavyweights, coupled with Reliance, are offsetting the weakness that banks and IT are showing at this point in time. So it's absolutely neutralizing itself. Banks and IT down, but you've got some of the other big boys holding up the green end.
Okay, all right. Let's focus on a few stocks. And Spandana Spurti continuing the gains that we saw yesterday. Bazooka move yet again. Massive volumes on that one, up 7.5%. Indofarm Equipment listed yesterday, ended in the green. Today, in fact, it's building onto that, up close around 5%. Aegis Logistics, if I remember correctly, Jay Bala was quite positive on the charts with regard to Aegis Logistics. Yesterday, it went up, I think, 15%. Today as well, it's up close to around 4%. So solid move is what we're seeing on that particular name. What's not doing too well? Ola Electric, not the one for the faint-hearted. For the time being, the negative news flow is weighing on the stock, down close to around 3%. ITI, definitely not the one for the faint-hearted. Yesterday, the stock was down 10% from the top. In fact, today it's down another 5% or thereabouts. And Kalyan Jewellers, the sense you get is that the street has read something more into it, because the operational update wasn't bad. From yesterday's high, it corrected close to around 5%. Today, it's down another 2.5%. We'll have to wait by to see what's the news flow on this one. But that's clearly a spot of bother out there. The stock is down even as we speak. So the headline index is more or less flattish. The mid-cap index, well, a little bit lower than what the headline index is doing, but plenty of stocks moving around. Ashiana Housing doing well. Borosil Renewables as well is higher in today's trading session. So big move is what we're seeing on a couple of these names. On the flip side, a couple of stocks that are losing out. You have TBC that's down close to around 5%. ITI is moved even lower as we speak. Prashant.
Well, lots happening, isn't there? And Reliance, by the way, those positive notes and the damage in the stock, about 1% pop this morning as we start a new session. I mean, this is as flat as they come on the Nifty, right? I mean, less than 5-point change, nothing at all. And you've got the Bank Nifty, which is slightly lower. So that's the start, slightly slow and sluggish. Venugopal Garre is now with us. He's a market master of the day, managing director, India head of research at Bernstein. Venu, good morning. Great to have you back on the program. Thanks very much. Venu and the team at Bernstein, of course, were one of the first who started cautioning about this, slowdown in growth momentum, business cycle momentum, risk to earnings, etc., etc. And all of that has played out, especially in H2 of FY25, starting, I think post-July, post-August or so. Those things have panned out. And where do we stand now? Prices will move ahead of news flow and actual data, etc. So is there any sense in trying to be slightly ahead? So what I'm getting at is, if the slowdown, etc., is materialized, should we try and price some sort of a reversal at an underlying growth level, and then, of course, for stocks as well? Basically, start to dip your feet and start to buy stuff at the margin. Your thoughts?
Prashant, thanks for having me on the show. I think you have given a very good backdrop. I was about to say and claim some victory for last year's weakness in macro, but you sort of laid it out for us. So just to put in perspective that my thinking is pretty much similar to what you're saying, that after being cautious last year with the 23,500 Nifty target, with the view that macro would weaken, earnings looked frothy with room for cuts and of course no upgrades, we are in a situation where to a large extent, in my view, macro has bottomed out. Bottoming doesn't mean that we are going to swiftly move up to an amazing economic story this year, but yet bottoming itself is a pretty interesting thing to watch, because when macro bottoms, you also tend to see incremental earnings risks also tend to reduce beyond what you would have already modeled, which is pretty much setting up you for a situation where in this weak phase, in my view, one should be buying stocks. So we've sort of reversed our stance of being cautious to not buying in general to a situation where we want to be a bit more proactively this year, especially in the first half when things are weak, to be buying equities. Target for the year is 26,500, which is 12% odd returns at a Nifty level. It's a good enough return in my view.
Okay, all right, Venugopal. That's really good to hear. So good, good start to 2025 then, because you've been, of course, one of the more cautious voices on the street for the better part of 2024. But I mean, we've heard everything you've said. You're saying that macros are bottoming. This is the time to go out and start buying stocks. So let's get straight to it. What's the construct then? If you were to create a fresh portfolio right now, I mean, what would get top billing?
Yeah, so, the way it works is the ways to play through the year will change. In terms of the sector construct that we have today, 3 months later would be different. But the idea is that at this juncture, we are overweight financials with a slightly lower weight than we had last year. And the idea is that macro bottoming out and recovery is still a 2-3 quarter process. So we're going to probably strengthen our weights on financials through the year. But at this juncture, we're overweight financials. IT services, we've actually increased weights. If you look at any near-term damage that you see from an economic standpoint, being exposed to potential positives coming in from US, rupee depreciation, which is already played out to some extent, but rupee is still a bit overvalued. So to the extent you still have some depreciation tendency left, IT services probably is a much better way to play that, given that we are moving off a relatively lower growth phase of last 3 years to maybe an okayish phase. So that's like the trend line. We also decided to upgrade utilities to overweight. The idea out here was that it's relatively more safer and calmer as a space, and you'd have seen the damage in terms of stock prices last year, especially in the second half for utility stocks. Telecom is an overweight for us, but that's a continuation of last year's overweight. There are various ways to play that, but the reality is that it's a relatively more steady annuity sort of a business, which is not really too impacted by macro in a major material way. I would probably say that these are the ways in which we are sort of playing. We are still sort of neutral-ish on consumer, even though we upgraded consumer staples from an underweight to sort of equal weightish per se. And the sectors which we still don't like are sectors like industrials, where we think that they're still overvalued. And the better way to play that is through utilities.
Okay. Hi, Venu. Good morning and good to see you in. Wishing you all the best for 2025. You've given us the upside target, 26,500, give and take everything. You're still factoring in a 12% increase in this year on the Nifty. But I think given the current market construct, the street would like to know what is the downside risk as well. On the downside, where could we visit? If you could give us a level out there, point number one. Point number two is on earnings. Clearly, the street is very, very nervous with regard to earnings growth. And it appears FY25 is going to be a weak one, but all hopes are on FY26. So what are you all factoring in terms of earnings growth? Downside as well as earnings growth. Please go ahead.
Yeah, so first, let me give you the earnings construct. Look, we all have data. We all know what's going to happen in the near term. The earnings picture is not that great for FY25. First half of the year, we were close to flattish, especially for large caps in terms of YOY growth. Second half, there's an expectation of 15 to 18%. Highly unlikely that we achieve that sort of a big lift YOY. So what it means is for the full year, you end up at sub 10% sort of numbers from a growth standpoint. But as we sort of look at the broader thinking about economy itself bottoming out, and there are a lot of things which did not play out last year. For example, capex did not play out last year. Consumption was, in general, fairly weak from a YOY base perspective as well. These are the things which would start to pick up in the financial year FY26, which is somewhere 2 quarters from now, which is where for next year, we would probably be of the view that they would be relatively better earnings growth compared to what we've essentially seen in FY25. Now, from a next 2 year perspective, my broader macro forecast is for a 6.5% plus GDP, and not the 5.5% that you see in the that you saw in the previous quarter. So to that extent, as you start to see economy inch up above 6.5%, my broader thinking is that getting a 12% plus earnings growth on 2 consecutive years is not necessarily a very big feat. Even in a phase of 10 year of downturn that India saw, we saw 7-8% earnings growth. So 12% in a situation where you're going to see macro recover is a good enough possibility. So that's what we are essentially modeling. And if you see, we're not really building in re-rating for the price to earnings, and that's the reason we've got a very similar market returns target as well. The second question is more on downside. I guess I personally tend to play a lot when I take market calls on sentiment. Sentiment last year, mid of the last year, was exceptionally strong, and that's why I was very negative. Now, I actually think that sentiment is very negative at this juncture. Everybody is aware of the risks, the worries, currency, Trump, what could happen to macro side, will government actually accelerate capex and things like that. So I guess the way to look at that in terms of modeling is very simple. Last 10 year, Nifty probably bottom close to 17x in terms of 2 year forward PE. And even if we assume somewhere in the 7 to 8% sort of earnings growth, which is usually in bad times, somewhere around 22,000 or below is like more or less the hard bottom for Nifty. Now, that's not really far away.
Okay. Got it. Venu, one more quick point. We're looking forward to some kind of support, both policy support as well as monetary support. The RBI, what are you all factoring in terms of their action? As you've mentioned in your note, this is the longest phase that you've gone without seeing a rate cut. I think close to around 700 days, which is even longer than 2004. So how many rate cuts are you all factoring in from the RBI?
Cumulatively, at the bare minimum, 50 basis point is a likely possibility that we see. Remember, the policy challenge is the fact that rupee is depreciating. And rupee, in our view, based on the broader metrics, is about 7 to 8% overvalued at this juncture based on where other currencies are, where US rates are, and other things. Of course, that overvaluation could moderate over time when the market realizes that probably Trump's actions may not be as inflationary as you're already assuming today. So to that extent, the room for rate cuts could be higher than 50 basis point. But remember, it's not going to be a first half driven sudden cut in rates. I don't think RBI can manage the currency spiral that easily. So think of it as more as very minimum 50 basis points. And I do believe inflationary risks are much lower than what people believe.
Got that. Venu, one line in your report kind of stands out. And I think you're being tongue-in-cheek there, right? You say domestic flows have so far been immune to fundamentals, but it's the backstory. It's not exactly looking ahead. But I think you say that it seems they're investing for India 2,280, while low-quality IPOs continue getting attention.
Yeah.
It was from the heart, Prashant. It was an emotional gesture when I wrote that report. But that is the reality. I mean, let's be very practical about it. I look at India year to year, maximum a 3 year bucket. Who knows what's going to happen in 2040? And the reason I wrote that is because whenever I argue that SMIDs are in a bubble, I get sort of a pushback that India is going to be the largest economy in the world in 50 years. There's so much amazing growth story left. I think that's just storytelling. Nobody knows what's going to happen after 3 years. So this was primarily directed at that set of sort of commentary or investors or the feedback that I get.
But it is also true, while we keep that skepticism, we know, for people who can invest in India and are investors, I mean, they must believe, right? I mean, that's the first step. But you
don't need to believe in a 50, 75, Prashant, you don't really need to believe in a 50-year story. Honestly, we don't even know the shape of India 50 years from now. But the fundamental reality at this juncture is that the first stage when you actually see, let's say, 2-3 years of massive macro collapse, you're not going to be talking about, India great story at that point of time. Fortunately for us, we are in early cycle. That's why I don't really see those risks playing out over the next 2 to 3 years, where you have to basically scurry and worry about, big collapse in the markets, right? So that's the only aspect I would say. But I don't think you should mask your near-term 1 year, 2 year views with 50-year stories.
No, absolutely, Venu. I'm glad you say that because there are analysts on the street who do write, of course, for the very, very, very long term. But I guess you, keep it more real. Just to wrap this up, so I'm just summarizing everything once again. Basically, you're saying it's the time to be cautiously optimistic. You're expecting a 12% index return this year, right? And what about earnings? What's your final number for FY25? And more importantly, FY26? What's the kind of earnings growth you're penciling in?
In a very simplistic way, think of, when I say earnings growth, is typically I talk for Nifty 50 rather than for the overall NSE 500. Because NSE 500 will be, mid caps will have higher earnings growth than large caps, but Nifty 50 is somewhere in the 8 to 10% range for this year, 12 to 13%-ish for next year, another 12 to 13% for FY27. So over a 2 year period, from the next financial year, it is basically somewhere in the low to mid-teens. That's like the broad number that I'm working with.
All right. Okay, Venu, we'll leave it on that note. Optimism is good. And to get that from someone who's been very cautious in the market for the better part of, the second half of 24, a very, very interesting call. And we'll hold you to it, of course. Thanks very much. Have a great year and look forward to more conversations. But time to move on to our next management. In fact, the next one on the show is Minda. That's the company in focus. To talk about the demand trends in 2025, we have with us Mr. Sunil Bohra, Group CFO at Minda. Mr. Bohra, great to have you on. Thanks for joining in. So I think, those are the conversations we've been having for the last couple of days as we're trying to gauge how many companies and corporates on ground are very realistically optimistic on the second half. The first half has been slower. You tell us, what are you seeing both in the domestic markets and in your global markets? Because even in the global markets, the automotive space has been fairly crimped in 2024, particularly in areas like Europe.
Yeah, so starting with the domestic market survey, so the first half, what we have seen, as you rightly mentioned, the auto market specifically domestically has been very good, led by the significant growth in two-wheelers, which has been into mid to high teens, and we do expect that momentum to continue in second half. And also the same way, the PV growth, what has been in H1, which has been a single digit, we expect that momentum to continue. But if you see the medium to long-term growth trajectory expected for the segment or for the sector, we are quite optimistic, and we have been significantly investing in building our capacities. As we know, we have been currently working on our 13 expansion projects, which is primarily mirroring the growth we do expect in the medium to long term. Coming to the Europe and the export market for us, though it is a very small revenue for us, it's around 12-13% of overall revenue, which comes from our exports plus the global operations. So specifically in, if you see in ASEAN, the business is actually very good. It's stable to positive. In Europe, yes, and Americas, the export has been little impacted because of some headwinds in terms of lower volumes, and we do expect that to continue maybe for some time now. We don't see any significant improvement in the near term.
Sunil, hi, good morning. Prashant this side, and Happy New Year to you and the UNO team. Before we come to the EV opportunity, Sunil, and what's happening there, because there are product launches, especially from players like Mahindra, etc., and of course on the two-wheeler side as well. Just give us a sense. I mean, you have added so much capacity, new manufacturing lines, new product categories that you enter into, and suddenly a new segment opens up in terms of growth for you. Just give us the latest in terms of the bigger product categories and how each of them are doing. Just the top 3-4 to give us a sense of, and of course your expectations for 25 for each of these.
Yeah. So specifically from the EV perspective, what you have touched base on, Prashant, we have been front runner in adding a lot of EV products, because a lot of our, not a lot, in fact, 95% of our existing businesses are not impacted by EV. They have They are basically agnostic to any type of energy vehicle runs on, be it seats, lamps, etc., etc. On top of it, we have been building our EV profile for starting with two-wheeler and three-wheeler very, very aggressively. And the kind of product profile we are seeing significant traction. And if you have to convert that into numbers, even our last quarter numbers, our revenues from the EV segment specifically of the two-wheeler segment is almost like 14% or so, whereas the industry penetration was around 7%. That clearly shows the benefit or the upside we have been able to capture because of the transition from ICE to EV. And even in terms of PV, we have been building our product profile gradually. Though the volumes are very low, we have been working on to see that when the volumes pick up in next 2 to 3 years, we should be able to capture lion's share. We have tied up with a couple of technology partners like EVSE and for EVSE product from StarCharge and EXL with Innovance. We have already secured some of the business from our customers for the wall-mounted chargers or EVSE, and we are in process of putting capex to deliver those volumes in next year or so. And from the other product, which is the EXL, etc., which is a high kit value product, almost 1.5 to 2 lakh rupees potential kit value. There we are still working on our project schedule and project plan. And in another 2 to 3 years, that project also should be up and running. So that's the broad perspective on the newer products which we are adding. On top of it, if you remember, we have also added products like sunroof, which again is a high kit value product. That is also in next 18 to 24 months, we'll see a start of production because it's linked to the business we have secured with the launch of the new model of the customer.
Sure. That's pretty interesting, Mr. Bora. And just to follow up on the whole EV part of it, as you add these new products and as you expand your EV offerings, even on the four-wheeler side, how much of your business will have EV exposure? I mean, just trying to understand across two-wheelers, four-wheelers, across the board. And typically, when you sort of offer more EV products, how do they compare in terms of margins? I'm not sure. I mean, whether it's switches, whether it's any of the other components, do they fetch you better value? Because whether it is local PV manufacturers or even international, I mean, EV is definitely it's here to stay.
Well, definitely, it's little early to comment on margins on EV Surabhi because we all know that even our customers are trying to penetrate the markets with attractive pricing. So it's little early to expect that we will be able to make a better margin on EV products. But as volumes ramp up, we do expect our margins overall to be in line with the business margins because today a lot of the EV businesses, we have set up some capacities. They are not 100% utilized. They are gradually sort of expanding. And as we move forward, we do expect that operating leverage factor to come into play. But what we have to consider is that all the existing product, what you mentioned, like switches, lamps, seats, they continue to be in EV as we have in ICE.
And ICE, yes, both.
Yeah.
Absolutely. Plus you have the new products which are coming in specifically for EV. Interesting times, and I think once third quarter numbers are out, that's when we'll discuss further financials and projections for the full year and for the next year. But for now, thank you very much and good luck for 2025. That's Uno Minda. On that note, we'll have to take a very quick break. Come back on the other side. We'll do a quick check on the markets. And of course, we have the management of Nuvoco Vistas joining in. They're looking at a cement acquisition. More on this in just a bit.
Welcome back. Keep an eye out on a few stocks. Kalyan Jewellers is calling for attention. From yesterday's high, it's down close to around 100 rupees, and the volumes are very, very large. So we'll have to get further clarity on this because otherwise the numbers didn't look too bad. But Kalyan Jewellers is the one that's under immense pressure, down close to around 5.5% as we speak. Let's focus on the cement space, though. Nuvoco Vistas, they have won the bid to acquire Vadraj Cement in the insolvency resolution process. To help us out with how things are shaping up, few details on this particular acquisition and the way ahead, we're joined by Mr. Jaikumar Krishnaswamy, the Managing Director at Nuvoco Vistas Corporation. Well, thanks a lot, sir, for joining in. Good speaking to you, and it's been a while since you joined in. So let's get straight to the point, Mr. Jaikumar. What is the tentative deal size of this particular acquisition? And also, you'll have to incur some capex since this plant was shut. How much is that?
Okay, Vadraj Cement is two plants in Gujarat. It has got an integrated clinker unit in Kutch for 3.5 million tons of clinker. And it has got a grinding unit in Surat with 3 VRMs. So the installed capacity of the grinding unit is 6 million tons and the clinker unit is 3.5 million tons. So this came through the IBC process, and we bidded for it sometime in the month of May and June. And the bidding process happened during the Q3, and finally yesterday the letter of intent was received. So the deal costed us 1,800 crores for the assets. And on top of it, we have done a complete due diligence of the sites and have a technical estimate of how much it will cost to rebuild both the sites. Both of them have got well-established equipment, just that these equipments have not been in service for the last 4 years. So it will cost us approximately 1,000 to 1,200 crores. Overall, we are looking at 60 to 65 US dollars per ton of cement from this deal.
Okay, all right. But how are you going to fund this particular deal, since your debt is in excess of around 4,000 crores odd as of last count?
So in all of our quarterly earnings call, I have been mentioning that around FY23, Q25, Q4 or Q1 FY26, we will start our next phase of expansion when the debt levels of the company are thereabouts 3,500 to 4,000 crores. And as we progress this year and end this year, we will be around that kind of debt levels for the company. So how do we fund this deal going forward? We still have got 6 to 9 months when the NCLT approval takes place. We're currently under the process of working out a funding mechanism through which we will fund this deal. One of the things we are very clear is we will have to ensure that the leverage on the Nuvoco balance sheet is appropriate, and we will meet all the covenant conditions when the deal is consummated.
Mr. Jaikumar, I'll have to push you a little bit more. Give us a breakup with regard to the funding, since you're already going to be taking on close to 1,800 crores of debt from this acquisition. So give us a breakup on the funding.
Currently, we have a business which delivers close to about 19-20 million tons, and the current pricing and profitability levels, Q4 and then beyond looks when the overall price stability happens and the overall profitability of the business improves. And our confidence level says that we would have adequate internal accruals to fund the capex program of this deal.
Okay, all right. So we'll have to wait by to see how much of it will be internal accruals. But let's get a basic point out of the way. Your current debt is around 4.3 thousand crores, very, very roughly. Given that you're going to be taking on some debt, what will the peak net debt level look like for the company?
No, I can answer this question simply by the fact that in the last 2 to 3 years, quarter on quarter, our debt levels have been pared down when compared to the previous year's number. And as I stand at the end of Q3 and beginning of Q4, I'm looking at a number which I have made informed during the earnings call. So at this kind of numbers, it's very difficult for me to kind of project a peak level debt at this point of time, because the peak level debt is a function of the profitability of the industry as well as the overall demand scenario. But sitting here, I can, looking at the last 6 to 8 weeks of how the demand has progressed and how the pricing is shaped up in the industry, I'm pretty confident that as we traverse Q4 and well into FY26, the overall profitability of our business will improve, and we'll have adequate internal accruals to fund this deal.
Profitability will improve. You know, the reason I'm asking about the debt is because the street would like you to keep your leverage under check. But let's focus on the equity side of things. Is it possible that you raise some equity to fund this deal?
I won't be able to comment on the instrument of funding in this deal, but we still have 6 months. We are cognizant of the fact that we have to ensure that the balance sheet of Nuvoco is steady and we meet all the covenant conditions. And within the framework of all the covenant conditions, we will be doing the fundraise for this deal.
Okay, so the funding is still a little bit sketchy, but let's focus on what could the synergy benefits be. Since you already have exposure to the region, you must be having some kind of synergy benefits that you're factoring in. Could you tell us what could that quantum be in that particular region, that's north and west?
Vadraj comes us with two distinct advantages. One of the principal advantage for Vadraj exploration was to get into an area where we are not present, which is namely Gujarat, Western Maharashtra and Western MP. So this gives us access to new markets. So, and makes this company from largely an East-centric company to a East, North and West-centric company, which will take us our capacity from 19 million tons in East, another 6 million tons in North. Overall, we've got 25 million tons of capacity right now. Another 6 million tons in West will take us to 31 million tons. So the primary objective of the deal was to fund the growth engine of the company going forward. However, with our current sourcing model of Gujarat as well as Northwest Maharashtra and Western MP, this markets are serviced from a Chittorgarh plant. And then once we have this Vadraj asset with clinker in Kutch and grinding unit in Surat, we are looking at synergy benefits in logistics as well as the inbound freight, whereas we targeting to unlock close to about 100 to 150 rupees per ton in the overall cost base of the company servicing these markets.
Okay, 100 to 150 rupees of cost synergies in North and West region. Got that. Let's get an industry-wide perspective for you. Do you believe that cement prices have bottomed out from the multi-year lows? And have you taken some price increases in the recent past?
If we had this conversation probably 2 months ago, I would have presented a gloom and doom scenario with prices really going down and certainly bottomed out in October and November. But I think come December, we've had price increases. We took price increases in East as well as in North markets. And albeit not very big price increase, but we have indeed taken price increase in all the key markets in East as well as in North. And this number should hold good in January and beyond. And with this kind of improved numbers, it will show up the overall performance of the entire industry and certainly for Nuvoco. I'm only targeting with better mix of premiumization and geo mix and focusing on key markets, we can unlock a little bit more value for the organization. Overall pricing, as you asked, my view is bottomed out this fiscal. And from now on, I think certainly pricing should improve and overall improvement in the results of the entire industry should happen going forward.
Got that, Mr. Jaikumar, but we need to ask you this final question before we let you go. There was some part of the market that was expecting a bit of a sellout from Nuvoco's promoters. Could you clarify and clear the air on this point? Is Nuvoco on the block?
I think, how could I answer a question like that? The fact that we have demonstrated that we have an appetite for growth and we have cemented our leadership position in the market, and we are now continued to be a fifth largest cement company, moving our capacity from 19 to 25 to 31. It speaks very high of our commitment to stay in this industry and grow the market.
We appreciate you joining in, Mr. Jaikumar, and clearing the air on that front. So since you're focusing on growth and expansion, you're clarifying that Nuvoco is not on the block. Congratulations on this Vadraj cement acquisition, and we'll hold you to some of those numbers. But the other big takeaway for the industry perspective is he believes that pricing has bottomed out and things should look up from here on.
Okay, all right. That's an interesting chat with the Nuvoco management after a while. Let's just look at the Nifty sort of as well and take a look at what's happening. I think there has been some recovery from the day's low, which is set in. The Nifty is flattish, but I think the Nifty Bank is the one which has come up quite nicely. So 70 points lower on the Nifty. The Nifty Bank, which did better yesterday as well, has recovered. Yes, so that is doing better. It's in the flattish kind of zone after starting down. So from the lows, it's picked up. So 50,150, banks doing better than the Nifty. And maybe just sort of round this up with the look at the mid and the small cap indices as well. And then we'll
cap
sort
down
of...
1.3. The decline is far more pronounced in that part of the market.
Full reversal of the 1% pop that we saw on the mid cap index yesterday. And small caps also down about 1 1/3% or so. Well, we're talking about GDP numbers at about 6.4%, slightly slower growth, etc. It's important to see the implications of that and whether something is showing up in sectors like real estate, right? So many linkages from that one sector and so important for the overall economy and, of course, markets as well. A recent Knight Frank report suggests that residential sales were at a 12-year high in 2024. They're also expecting strong fundamentals poised to sustain this year. We have Gulam Zia, Senior Executive Director at Knight Frank India with us. Gulam, we're chatting after a while. Good morning, Prashant this side. Thank you for your time. Happy New Year. So good
morning,
to hear
Prashant,
that you're...
And Happy New Year to you and your viewers.
Thank you very much. Good to hear you're expecting strength to sustain. But is there any way to tell, Gulam? Are there any indications, or suddenly, how does one tell? So far, so good. Sales are sustaining. There is strength, etc. For example, I'll tell you, I was talking to somebody in the hotel industry, and they were saying that I was asking them how the season has been, and it was interesting. The answer stood out. He said, well, it's been kind of sluggish this particular holiday season. And he said, well, one of the reasons could be because the stock market has been slightly sluggish lately, over the last 5-6 months or so. For real estate, I think the linkage is there, although there's no way to tell how much. Just your sense, top level, high level thoughts, and then we'll get down to it in terms of specific things. Go on.
Well, you're absolutely right. Most of the monies that we were watching coming into real estate were on the gains that you made on stock exchange. And many of those, especially the mid to high end and the luxury, uber luxury segment, was thriving because you had so many IPOs, people pulled money out of stock exchange and so on and so forth, and all of that. Most of it was coming because you're buying, apartments of 100 crore plus worth, maybe in a lot of them in Mumbai, but quite a few in Delhi. So when you're talking about some sluggishness, I'm sure it will reflect on real estate as well. But so far, it is not showing any signal of any slowdown because the numbers are very, very strong in the whole 2024.
And more importantly, looking ahead as well, it is looking pretty good, right?
Indeed. Because when we are looking at...
And the big markets like NCR, etc. as well? I mean, the NCR, Mumbai, etc. looking...
Well, NCR of all the top 7-8 markets, NCR is the only market where we have seen some slowdown, about 4 to 5% less volumes compared to 2023. That's the only market where we're expecting the number of sales to shoot up beyond 60,000. But it is the only one which has remained at 57,000, slightly lesser. But the signals are emerging straight away from Delhi. And I recall about 15 or 18 odd years back, it all started from Delhi. So I shudder to think that Delhi is giving some signals, but the other cities are yet not following because we continue to see growth in numbers of transactions.
Gulam, hi. We discussed this with Mr. Ashok Tyagi in the last week of 2024. I remember asking him exactly this. Is there too much of over-exuberance in the whole sold in 2 hours, sold in 1 day, whatever's been happening for a lot of, developers, including DLF. And he actually at that point in time told us that they have started taking some precautionary steps. They've increased the down payment, for instance, to ensure that there is a genuine demand, not the flipping. He says he's still not seeing the sign of the so-called flipping, which was the peak of the last cycle, where you buy and try and flip in 6 months. He says that's not visible just yet. But anyway, season's greetings to you and a very happy new year. So we need to watch for Delhi. That's takeaway number 1, Delhi NCR. But let's talk about the other markets as well. Let's talk about Mumbai. What do you see ahead here? Where are we in the cycle? Is a lot of this genuine, buyer demand? How much is investor demand? And where is Mumbai in the realty cycle? What do you see in terms of transactions, volumes and pricing in 2025?
When we average out, when we're looking at the macro picture, a lot of things are hidden in it, because when I'm talking about almost 100,000 number of units sold in primary market, which is when the developers are selling, almost about 98,000 apartments were sold in 2024. But then if you dig deeper, and this is the first time I haven't seen any other data provider talking about it, we have absolutely analyzed the upper end, because for last 2-3 years, everybody is talking about luxury. We tried to find out exactly what does it mean. So when we break it into various sectors, 5 to 10 crores, 10 to 20, 20 to 50 and 50 and plus, here a few signals are emerging. When it is absolute uber luxury or ultra premium segment, as we call it, 50 crore plus, in that segment, there is hardly any stress. The apartments are selling like hotcakes. And also the inventory, because ultimately when you look at the demand and supply scenario, the velocity of sales, whatever inventory existing in that category, which is 50 plus crores, will be actually exhausted within 4 to 5 quarters. But when you look at the very next segment, which is 20 to 50 crore segment, here we can clearly see some stress building up especially in Mumbai, because this market is very exclusive, Mumbai and Delhi alone. But in Mumbai, we see a lot of signals emerging, because the inventories have come in a lot in that segment. And we are looking at almost about 5.5 years to exhaust that inventory. And that is a sign of worry. That is a sign of worry, because in that segment, the velocity of, or rather the launches have been a lot. And that's where the problem is. Rest of all the other sectors are doing absolutely fine. Of course, the absolute lower end of the market, the affordable housing, hardly any inventories coming in, and hence it is suffering. But the key takeaway is that the 20 to 50 crore, a lot of inventories have come in last 2 months.
That's a big headline, that in the city of Mumbai, inventory which is in the 20 CR to 50 CR bucket, there's 5 years of inventory right now in the market, and we need to see if it's exhausted that well. What about the buckets below that? What about, the definition of affordable is very different for Mumbai, but if you talk about, and let's also expand this to other markets like Bengaluru, etc. If you talk about the, 1 CR to 10 CR sort of broad range, which is, let's call it affluent housing, what's happening here with respect to inventory? Do you still expect the same level of absorption?
Well, I can generalize it. Except for this segment in Mumbai, everywhere else, I'm looking at 5 to 7 or 8 maximum quarters of inventory lying in the market, which means within 2 years, you will sell whatever wares you have, provided you don't launch any further. So which is where we are right now. Every market, except for this one segment in Mumbai, is in that 7 to 8 quarters of an inventory availability, and which is nothing to worry about, including Bengaluru. Even in Bengaluru, when we look at the 10 to 15 crore or 20 crore category, even there, it is not more than 6 quarters of inventory lying, which means even that is a very healthy market. In all of this, one market which is standing out is Hyderabad. Hyderabad is one market which is actually in price points as well as the ticket sizes are actually almost about Bengaluru or even beating in a few cases. But even there, the inventory in the mid to upper end and the luxury segment is absolutely in control, which means not more than 8 quarters of inventory lying in the market. So as I said, once again, except for that one category in Mumbai, everything else is like, at least now, looking absolutely all right.
Ghulam, now let's do some stock picking with you. I say replace the word stock with micro market picking with you. Give us some ideas. I mean, if people have some real estate investment money lying around, what are the micro markets one should look at specifically?
Look, I'm very, very clear on this. For last so many years, almost about 12, 15 years, I'm talking about it. Don't punt on real estate. The real estate growth at 7-8% per annum kind of improvement of price appreciation is not the market when you compare with other investment options. So whatever sales we are talking about, even in the upper end, you're not expecting people to keep flipping. And I think you just about short while back, you spoke about it. Flipping is not happening. Perhaps the people are much wiser today. They know that you cannot expect the prices to double up in 5 years. Only then. I always tell people, if you're confident that whatever you're buying will give you 100% improvement in next 5 years, you should buy.
I get it, Ghulam, I get it. But there are lots of people who will not miss the money, even if they want to put.
They want to own a hard asset, for some of them.
For investment or for whatever, right? I mean, they want to park money. So for that category, and there is a category, there is that cohort of people, because so much money has been made through markets, through stocks, and here also the rate of growth is kind of start to slow down a little bit. Can't go like this forever. So naturally, you start to look at other places. So for that segment, Ghulam, what are the best micro markets in that sense?
In fact, I'll only talk about 2 points. If you want to invest in land, buy land. And there are a lot of developers who are coming up with these, large townships where they're selling land, because land is where you have maximum potential of an improvement. But that said, since we're talking about the luxury and uber luxury market doing so well, ultra luxury segment people are buying, here it comes to investment of passion. You're buying these apartments because you want to show the society that you have arrived. And that's what it is. When you're talking about the upper end, all these transactions are straight away hinting at that. Nobody is expecting the prices to double up. Like, for example, if you're buying an apartment for 50 crore or 75 crore, you're not expecting it to grow to 200 crore in times to come. It's only because you want this apartment and you will be staying in it.
But land where, Ghulam? Sorry to press you, land where?
There are a lot of these locations in the remote areas of these metropolitan regions of Mumbai, Delhi, Bangalore, etc., which are improving by way of infrastructure connectivity. So you have a lot of these infrastructure pieces falling in place even in Mumbai. So when we are talking about, say, Vadhavan, you know, the place where you are going to have a new port coming up altogether, absolute greenfield area, nobody has ever spoken about it. Otherwise, you have areas towards Bhiwandi or Panvel, even Panvel to Alibag are the locations where a lot of these developments are coming up because of improved infrastructure. Can you imagine by road traveling from Nariman Point to Alibag will not take you more than an hour in times to come with Atal Setu and a last mile also connectivity happening in a year and a half or two. So a lot of these infrastructure connectivities are going to improve your land connects around the cities, and that's where you have to look at, because that's where actually the improvement or appreciation will be the highest.
Okay, all right. Very, very interesting. Got it. Ghulam, you know what? I will thank you because I think Prashant is just walking out to figure out his checkbook and, you know, looking at his investments. I think the next couple of days he'll be making that long-term transaction. But no, jokes aside, thank you very much for joining in and educating us on what's happening. So the good news is that there is no red signal just yet, but we need to watch out for the category,
I'll tell you
the almost uber luxury category where there's a lot of inventory in Mumbai, 5 years of inventory. Got that. Thank you very much, Ghulam.
And the other point, what he said, right? Delhi NCR.
Yeah.
That is a market which...
Typically, it signals that there's problem coming.
You go a little too aggressive. We've all seen it, right? 2007, 2008. So, and I think Ghulam used that phrase, I shudder to think if we see a repeat of that, and that kind of becomes... but that's it's a very important sector for the economy, and it's crucial that the momentum in the sector stays strong. So far, it looks that way. We'll take a quick commercial break here. Manisha Gupta will focus on the commodity space when we return. Stay tuned. All right, welcome back. We've got the market down about 30 points. Banks are doing a little better. Mitesh is with us with what he'd like you to do. Mitesh, good morning. What would the advice be now?
See, I think on the index, it's still a choppy but non-rational kind of a movement. But what is interesting me is the stock of Reliance. I think after a long time, Reliance has come on the buy radar. So recommend to buy here with a stop at 1242 for targets of around 1300 plus. And, that one, could in turn, obviously, it will affect the performance of the Nifty as well. So I think that's one stock to watch out for. And on the selling side is Apollo Tires with a stop at about 495 for targets of 470.
Okay, all right. Mitesh, thanks very much. We'll watch out for these stocks. Reliance, of course, is doing really well on the back of a couple of brokerage upgrades today. But let's shift the focus now to the commodity markets. We have Manisha with us. Manisha, what's the latest? What are you looking at?
Well, I'm looking at the crude oil prices because this is one sector that has continued to gain into the markets there. If you look at the prices itself, we are looking at crude prices trading at a 3-month highs. Well, last year, the prices declined 3%. It was a second yearly decline for the crude oil prices. But when you look at this year and on a week-on-week basis, we've gained up by 2% for crude. And for this year, until now, we have already up by nearly 4% for the prices. Well, there are a few things that seem to be supporting crude oil prices at these current levels. One, it has underperformed, so there is some money allocation coming. Second, the U.S. crude inventories have continued to decline for a 4th straight week. So you are looking at tight global supplies, and that really seems to be supporting the markets. Well, escalating Western tensions that you are looking at on Russia and Iran is also yet another thing that is keeping prices higher. Important also is to watch on what Saudi Arabia really seems to be doing for its Asian consumers and consumers across the world as well. So Saudi Arabia has raised prices for Asia for the first time in 3 months, and this would start from the month of Feb. For the month of January rather, when you look at the prices, we are at the lowest we saw in last 4 years. But that really seems to be changing at this point in time. And the kind of price rise that we are seeing for the month of Feb is almost $1.50 barrel higher than what the regional premiums really seems to be going. So that tells you that supplies from the conventional areas is not coming. The demand for the Asian markets is continuing to be on the higher side, and that clearly seems supportive. The other thing also is that the latest data that has come in from OPEC shows that the December output from OPEC has declined by nearly 120,000 barrels per day. So if you look at the total number, that stands at just about 27 million barrels per day. And you are looking at maintenance activity in UAE. There also is production decline coming in from countries like Iran and Kuwait. And then Russia production also continues to decline. The December data shows that Russian output was at around 8.97 million barrels per day. So whether it is about inventories, demand, cold weather, it also has to do with sanction expectations. All of that seems to be supporting crude prices. Going forward, it is going to be about Fed meeting minutes that get released today. And then you have U.S. non-farm payroll data that comes in on Friday to give you further cues.
All right, Manisha, thank you very much for that. So that's commodities in focus. Let's revisit some of those standout stocks as far as the brokerage reports are concerned. Nimesh, of course, is with us with exactly that. Nimesh, good morning again.
Hi, Mani Prashant. So, today I had highlighted the standout was on cement. CLS has turned constructive on the sector, and they believe that the earnings visibility is improving, which means there are opportunities arising for buying. Today they've upgraded Dalmia to outperform from hold. They've raised the target price there to 2110. And they've upgraded ACC from underperform to outperform, so technically a double upgrade, and they've raised a target price there to 2580. Now, the three big themes for 2025 for the cement sector: one, capacity demand recovery; two, consolidation and capacity expansion; and three, profitability on back of low base and cost savings. In terms of individual stocks, they continue to be overweight on Ambuja Cement. On Dalmia, while they've upgraded the stock, they feel that the lack of medium-term earnings visibility is pretty much in the price, and hence there was an upgrade there. On ACC, while they have upgraded the stock, double upgrade the stock, they continue to prefer Ambuja in the Adani space. They like Ultratech Cement, but they believe that the risk reward is quite balanced. The only underperform rating they have is on Ramco, and there they are awaiting for more clarity in terms of growth emerging. So that's the preference list. But today, a big upgrade on Dalmia Cement to outperform, and an upgrade on ACC to outperform with a target price raised to 2580.
Okay, all right, got that, Nimesh. Thank you very much for those updates. We'll watch out for those cement stocks. Let's talk about some more brokerage notes that are quite interesting. Rarely is it that you see a brokerage come out with a negative view on renewable energy plays, but that's exactly what I think Kotak has done with Vari and Premier Energies. Vivek, tell us more.
Well, the negative view, like you mentioned, is largely based on the valuation. Overall, they're quite positive as far as the solar value chain is concerned. What they're saying is that the India's solar sector is primed for growth, they're anticipating 18% CAGR in utility-scale solar capacity additions till FY30. Along with that, Indian solar companies are well positioned for strong growth in domestic as well as US markets. This is aided by both trade as well as non-trade barriers. What is it that they find will be the key earnings drivers for two companies that they have initiated coverage on, the Premier Energies as well as Vari? What they're saying India capacity addition as well as backward integration aids them, expansion into US cell manufacturing, higher capacity utilization, and they are also anticipating margins for both of these companies to peak in FY27, given the fact that they anticipate competitive intensity could start impacting their margins from FY28. So as far as Premier Energies are concerned, initiating coverage, sell rating, fair value of close to 770. So they see 40% downside, to yesterday's close. And when it comes to Waaree, again, they have a sell rating over here. They see 7% downside to yesterday's rating. Remember, Waaree is the largest solar cell manufacturer and Premier is the second largest. So overall positive, but valuation is something that at this point of time, they don't find palatable.
All right, Vivek, thank you very much for that. We'll take a quick commercial break here. Our segment, it's the economy with Lata on the other side. Lata will be speaking with Sakshi Gupta of HDFC Bank and Pranjul Bhandari of HSBC, and they discuss the positives and negatives of the 6.4% GDP estimate for this year. Stay tuned, that's coming up.
Welcome to It's the Economy. The biggest news, of course, is that the Ministry of Statistics and Program Implementation, MOSPI, has projected the first advance estimate for the current year's GDP, and that number is put at 6.4%, lower than Reserve Bank's 6.6%, and a tad higher than our own poll of 6.3%. Importantly, it's clearly showing a slowdown. It's the slowest number in 4 years. But what else can we take away from the numbers in terms of consumption, investment, future growth? We are joined by Sakshi Gupta, Vice President and Senior Economist at HDFC Bank, and Pranjul Bhandari, Chief India Economist at HSBC. Ladies, thank you very much indeed for joining me, sparing time for us. Pranjul, are you in line with 6.4, higher, lower?
So look, broadly share the sentiments that it's going to be lower than we've seen in the last couple of years. But when you look at the exact numbers, we are closer to 6.2%, so slightly lower than the advance estimate. And the reason is, while we do think that second half will be better than the first half, we think the degree of improvement will not be as strong as what the CSO has come out with.
Fair point. That ties in with our poll also of 6.3. Sakshi, yourself, okay with 6.4?
Yeah, I think, Lata, we were estimating 6.4 for the full year and, 6.7 for the second half. I think based on a lot of the high frequency indicators that we have up till November, I think 6.5, according to me, in the second half seems achievable at this point.
But if it is 6.5 in the second half, you will not get to 6.4. It will be lower than that, right? It will be more like 6.25 or 6.3 thereabouts, correct?
Right, absolutely.
Yeah.
So I think
6.4 could be aspirational at this juncture, is it?
Absolutely. Yeah, I think that, these are just estimates based up till November data, and we'll have to see how economic activity actually picks up, especially in the fourth quarter. So at this stage, I do see some downside risk to the numbers, the first advance estimate numbers.
Yeah. No, to be fair, this forecasting up to the last decimal point is not always easy. The only thing is, I went back last 10 years and compared the advance estimates to the actuals. In the last 10 years, 4 years it was underestimated, 4 years it was overestimated, 2 years they were bang on. So it's not as if they have a very bad record of, guessing the advance estimates. But let's take the takeaways from the detail. Pranjul, one of the things that stared at me is that rural employment-heavy sector, agriculture seems to be doing well, but urban employment-heavy sector, trade, hotels, transport, is only 5.8. In fact, it has never recovered after COVID, this trade, hotels, transport, communication. Do you share that observation, and what will be the impact of that?
So, Lata, we do a very detailed exercise looking at 100 indicators of growth. And things were looking very weak in the September quarter, but we've seen some improvements in the December quarter. For instance, we've seen a big increase in agriculture, we've seen a big increase in exports, and we've seen a big increase in construction. So I think these are the positive parts of why I think December will be better than September. But having said that, I don't think it can go up to 6.7% growth like CSO is estimating. If you look deeply into the growth, you see that they have a very high private consumption growth number. And while I do think that rural will be better, agriculture will be better, remember that rural Indians generally spend after they sell their Rabi crop, which will show up more in the April, May, June quarter rather than now. That's number one. Number two, if you look at urban consumption, my sense is the informal sector is not doing very well, and CSO has picked up that sentiment by having a low trade transport number, as you say. And then the third part, which is the urban upper end, I think that consumption is also not doing very well. And I think we can pick it up from CSO's forecast of imports, imports which have a lot of consumer durables, which high-end consumers consume, that has been pretty low. So if you only have 1/3 of consumption, which is rural, doing very well, but not urban informal and urban formal, I'm not sure we can have such high consumption number in the second half of the year. So a little bit of overestimation, I think, is going on at that point.
Okay. Your take, Sakshi, how would you rate consumption? I mean, I'm asking you because now at this hour, when you're talking, there is a market audience and they worry about FMCG and consumer durables. What are you picking up on consumption?
Right. So if you look at the consumption estimate, right, private consumption growth estimate for FY25 at 7.2, 7.3, the number is essentially assuming that in the second half, consumer demand is going to grow by about 7.8%. Right, which I think, in my opinion, given a lot of the indicators that we are tracking both on the rural and urban side seem to be optimistic. Yes, there's going to be some amount of, I think, recovery on the rural side, but I think inflation still, at least up till December, the numbers that we're tracking still continues to be above 5%. Right, it still continues to be a pain point and it continues to weigh on demand both on the rural and urban side. And I think I agree with Pranjul that the rural demand recovery from a good harvest season usually comes in with a lag. Right, so I would expect at least 1 or 2 consecutive seasons, good harvest seasons, to change, discretionary spending decisions for rural households. So that's something that's going to gain traction, beginning of FY26.
Okay. Pranjul, any takeaways from the gross fixed capital formation number? It's obviously come down to 6.4 from 9% last year. But if you went to Q1, Q2 and the full year, are you getting a sense that private capital formation has not picked up? Because we all know that government capital formation is going to be higher in the second half. We didn't see much of it in the first half. So clearly not much sign of private capital. What are your takeaways?
Yeah, that's right. I think this week has not been a capex year as such, in the way it was in the last couple of years. You had the central government in where capex growth is growing at minus 12% year on year. State government capex has also been pretty weak. And then when you look at indicators of private capex, for example, industrial credit or infrastructure credit, it's not really been that high. So my sense is that generally speaking, capex has been weak. And I think, last evening's number actually picks that up. But where, again, I have a slight disagreement is that I think second half capex could be a little better than first half capex, not because private capex is picking up, but because central and state governments are making a little more effort to get all of that capex spending done. And I think that will get picked up a little bit. So I do think that while I do think they've overestimated consumption growth in second half, they may have underestimated capex growth by a little bit in the second half.
Okay. Yeah, it's possible. Or, they're probably expecting government to do well, but not private to do well, which is why the average is 6.4. I mean, I'm just guessing. Even the government capex is basically pushing that 1.5 lakh crore to the states. And now they're even talking about loosening the conditions because the states are not able to access that 1.5 lakh crore because of the conditions that go with it. So clearly, even that capex is becoming a bit of a problem. Sakshi, given this kind of a capex growth and consumption, how will you estimate growth in FY26 next year?
So Lata, our estimate for FY26 is that growth is going to, marginally increase to about 6.7 from 6.4 this year. As we earlier discussed, there will be some improvement, at least, in terms of cyclical improvement in consumption that is going to play out, primarily coming from the rural sector. I think on the investment side, I think even FY26 is going to continue being a story where, a lot of the investment is being pushed by the government, both the center as well as the state. I think the private capex story, I don't see a very broad-based pickup in private capital expenditure. I think there are a host of issues here from, moderate demand in the domestic market and a lot of, overcapacity globally in a lot of key sectors. I think some of these risks, at least on the global side, are not going to abate, but in fact increase next year with, large economies like China.
One minute. So your number is 6.7, correct?
Yeah.
Yeah, but Pranjal, what's yours?
6.5. For a while, we've been seeing that India's potential growth is 6.5%. And we are now going to come back to potential from FY26 onwards.
Okay.
From that sense, the last 2 years were actually a bit of an exaggeration.
Yes, of course, we had slack in the economy. But all this worries one that the Viksit Bharat goal becomes much tougher. The Reserve Bank's arithmetic assumption of 7.6%, I mean, the required rate is 7.6% if you have to be a high-income economy by 2047. We aren't anywhere near 7.6. That would be a bit of a worry. Well, Sakshi, do you see how do you see next year's nominal GDP? Can they take it up to double digits at all? Or will it have to be like this year's, 9.5 or thereabouts?
Well, I think, Lata, given, 6.7 real GDP growth forecast that I have and, retail inflation at about 4.2, 4.3%, I would expect nominal GDP to be somewhere around 10.5 for FY26.
Okay. And, so that makes it comfortable in terms of fiscal deficit, I suppose. Pranjal, your estimates of nominal GDP and therefore the government will be comfortable on fiscal deficit, you think?
Look, I think I'm in line with the advanced estimate number for nominal GDP growth of FY25, which is 9.7%.
Yes.
But I think for FY26, I think assuming a 10.5 run rate that like we had assumed in the last year, I think will lead to disappointments. I'm saying this because real GDP growth forecast for me for FY26, as I said, was 6.5. And I'm working with a deflator, which is about 3.5%, and that adds up more to 10%. Okay. And I think 3.5% makes sense. You have a WPI, which even if it increases, will average about 3, and then you have a CPI, which will average about 4. So I just don't see GDP deflator being any higher. So my sense is that any higher number than 10%, assumed by the government, will only lead to disappointment.
Okay. Okay, I'm asking a last question, which actually I should have asked much earlier. Manufacturing. I mean, it's such a disappointing performance. Pranjul, this is coming at a time when there were PLIs and import tariffs raised to encourage domestic manufacturing. And we have still barely, scrambled to 5%. Is there a chance at all that we will do better in manufacturing?
Look, I think a lot will depend on the policy and strategy of the government. I think we had a strategy of basically favoring some of the high-end sectors, and we've done well, in some of the high-tech manufacturing like mobile phones and mobile phone exports. But what has completely slipped from the radar is mid-tech and low-tech manufacturing, which makes up a very large share of the overall manufacturing, pie. And I think that's something that has to be pursued. I do think we have an opportunity. Supply chains around the world are rejigging. India can attract mid-tech, low-tech FDI and do mid-tech, low-tech manufacturing. But for that, the strategy and policy focus of the government will have to move a little bit away from the real high-tech and capital-intensive sectors like semiconductors. We have to move more towards things like textiles, toys, handbags. And I think there's a huge opportunity there right now.
Yes, but we've heard this. I mean, I think I've heard this ever since I started 11th standard economics. Wage goods theory of Dr. Brahman, and then it just doesn't happen. We've heard the Make in India theory, at least from 2013. And look at the share of manufacturing in GDP. It's 14% now. Actually, I think in 2012, if I remember right, it was 17%. We've come down to 14. And after all the PLIs and all the Make in India effort that we have put in, this just isn't budging. And I would think that, we talk a lot about urban consumption slowing. This is another theme that needs the attention of all of you economists and policymakers. But that debate for another day. Thank you very much, Sakshi and Pranjul, for joining me with the key takeaways from the advance estimates. Both the economists present here are a bit downbeat and believe that even 6.4 is ambitious. And even for next year, it's between 6.5 and 6.7. So the aspirational 7% still eluding. Wrap up on Bazaar. On that note, Chart Busters coming.